Hello, hello, and welcome everyone to Investment Friday. Today is actually Friday, January 30th. It is currently 10:04 a.m. Mountain Time, so noon Eastern, basically. And we are recording today for this week. And I'm here not by myself this week with my good friend Brad Haines, the CIO of Juncture Wealth Strategies. Hey, Brad, how you doing?
Doing well. How are you?
I am fine.
Good.
So
There's a
we'll,
lot to process this week. So
yeah, we will not get into all of that this week, but there's a lot going on in the world. I address that on some other areas of my social media. Um, and we've got a lot of stuff going on in the financial markets as well. So we're going to focus on that for today. And the news that just came out. So we're going to talk about the nomination that Trump just made for the Fed chair to replace Jerome Powell. We're going to talk about what's going on in the markets this week. I am going to ask you about jobs because we just got some news about some layoffs. And we're going to talk about qualified charitable distributions or QCDs from an IRA. So we've got our topics for today. And let's start there.
let's launch in.
So what's going on with the markets this week? We've seen some kind of like, I mean, last week was similar, and I talked about it last week. We've just seen quite a bit of volatility.
Yeah, I mean, little dips and up and down. I mean, it's a lot of volatility compared to the past year since April when we had the only volatility of the last 12 months. Um, with basically post April through December being very low volatility with the market rising. Um, we did have a couple of, things cause consternation this week a little bit. So investors were definitely taking some chips off the board, rotating into other different equities. Taking some profits on gold and silver, which did quite well this week, and all those types of things. So there's a lot of rotation, a lot of rebalancing that was happening, and the like. It's interesting because while crypto hasn't been moving nearly as much as it has historically, one speculation and one possible reason why is a lot of the crypto traders have kind of moved into silver and gold and copper, which is an interesting transition, where instead of trading crypto per se, they're actually trading the metals as well. So it's an interesting. I don't know if that's actually accurate. This analyst was just surmising that might be the case because of the excessive volatility in those metals over the past couple of weeks.
Well, I actually saw just a random something that was saying that there was someone took a 300 or 350 million dollar option position for in silver just this week. Like the question with that was, okay, who's going to be on the other side of that trade? Because an option is an option to I believe it was a call option, an option to buy. Um, but yeah, who's
Yes,
going to be on the other side of
I
that?
don't know what side they took on it. The
Oh,
problem
okay.
is there could have been a trade that could have been negative. They could have sold the call option. They could have bought a put option. They could have. So I yes, there were some very large trades that went through on the metals, particularly silver, this week. And silver isn't as liquid as gold, and certainly not as liquid as some of the cryptos and the equity market. So it can make exacerbated moves whenever you have large trades going through. It's interesting because metals are just metals, and they are driven by two things. One, fund flows, which are investor in and out of these contracts, and of these investments, and then um, underlying fundamentals, which over the medium to longer term, the fundamentals drive most of it. The supply demand imbalances or balance will drive metals up or down. They are not like equities. They are not companies that are mining the metal and then, producing and delivering it for process. Very, very different investments. So generally they will go up and down a lot. But these trends, because people are worried about the US dollar being the primary reserve currency, uh, gold and silver have gained a lot of popularity among central banks earlier, but now investors. So I think a lot of investors are definitely broadening out their exposure to those metals.
And when talking about this week as well, so I also, heard recently that gold has pretty much doubled, just about doubled in the last 12 months. So it's had a huge increase over last year. Silver has it's closer to like 275% or something. Like they've gone up quite a bit. Um and at the same time, literally, as far as yesterday, Microsoft was down almost 12% at one point
Correct.
during the day yesterday. And there were quite a few other big tech companies and cybersecurity companies that took pretty big hits yesterday. But then some of the other ones, Nvidia, Apple, they were like untouched. So that one was curious to me as well. I was wondering if you had any insight onto the discrepancy between like why some of them, usually when the big tech companies go down, they kind of go down together, right? It's like an AI trade. But Microsoft kind of had led the way yesterday.
Yeah, so it's interesting because over the past couple of months, you've seen a bifurcation within the AI ecosystem as to how the stocks are reacting. Um, Earlier in the AI theme, um, like you were saying, all the stocks would go up or down pretty much in concert. Now we're at the point where investors are differentiating between companies that can optimize AI, artificial intelligence, and that are gaining traction with users, consumers, businesses, and that's kind of the story of what happened with Microsoft. Their Copilot is kind of behind the eight ball quite a bit, from particularly when compared to Google's Gemini. Um, so it's this fight for adoption. Now, bear in mind, Google and Microsoft have a lot of other things that they do that will help them immensely going forward. But the way Copilot is being rolled out versus Gemini can be it can be an app on its own, but it's also embedded in a lot of Google products, and Copilot is only embedded in in Microsoft products. So and they rely on OpenAI to run that and to develop it. So it's interesting, but a lot of this differentiation from investors mean that there's extremes on both sides, positive and negative. If you have a lot of um, a tick up in users, a tick up in usage, a tick up in revenue from AI, you're going to be rewarded commensurately. If you don't, you're going to be punished because the investors are telling companies, look, artificial intelligence is going to be the wave of the future for a lot of software and software related products. So we want to see you giving more. For example, Meta came out and said, hey, they're going to invest a bunch of money more into artificial intelligence. And it was rewarded. Investors rewarded it because they had some good results from that. So again, it's some of that same um, dynamic where companies are going to be judged by their own merits, not by the theme in general going forward.
So that's interesting. Because again, it's differentiating now, or almost, I don't want to say like the market is picking winners and losers, but we might be getting to that point where we start to see the companies that are really like rising above the pack, is what I'm hearing.
Absolutely. Absolutely. And that happens when, we get to the point where competition becomes very, very critical. And that's where, right now, if you look at all the large language models, there's a lot of them
Hmm.
compared to what we probably need. I mean, if you look at the search engine world, how many search engines are out there that people use? There's a few, but from by and large, Google owns that market. But there's some few others that, for various reasons, people use. Um, well, right now we have a lot of large language models, and we have a lot of companies that are investing a lot of money in getting those models to the point where they're going to be one of the main ones used. We don't know who's going to win that yet, and it's probably one of the models currently in existence, but that may not be the case either. It may be a dark horse out there that comes out of someone's garage and sweeps the world. You never know. I mean, that's the tech the tech dream, right?
Yeah. Well, that and the kind of what am I trying to say? It's not a trope, but something that's happened many times is that whoever spearheads something brand new, right? Like the person who is first breaking through, or the company that's first breaking through, creating a new technology, doing all the education, really helping people to understand, why we need this thing, and bringing something brand new to market. They're not always the ones that get to capitalize on it the most. It's the person that comes behind that says, "Oh, I see what you did, and I see how it can be done better." Or I'm better at marketing, and I have a better, like, I have a better platform, and so now, I'm going to take this idea, iterate it enough so it's different, but, have better marketing for it. And that's the one that's going to take off. And that happens a lot. It's just in business in general, and has.
Yeah, I mean, it's creative destruction. It's competition, which is how the capital markets work, and it benefits consumers and businesses a lot to have that competition happen.
So, also with AI, and I'm just going to use that as the entry point, because that's why it's being touted, that Amazon is laying off another 16,000 workers, just announced. Kind of put AI in there as the reason why, AI can do some of these jobs. Um, what is that doing to the labor market? What are we seeing overall? Do we have any figures? Or when does that next report come out?
Yeah, so payroll and numbers come out every Friday. Um, the unemployment numbers come out on every month. Um, so, but we have to understand that layoff announcements um, will not hit payroll numbers for months. And the
Mm,
reason why is because if you get laid off, typically you have a period of time where you're continuing to collect a paycheck, and you're not working, you're just getting a paycheck. And then after that period, if you don't have a job by then you go on the unemployment payrolls. Okay. And that's a really important distinction, because these announcements could take a couple months to actually go through, where they actually do lay off people. And then that period of time, again, where they're continuing to get paid, it could be from 1 to 6 months, generally speaking, where they continue to collect a paycheck. Oftentimes workers are uh, busily trying to get to a new job, right? And so they're actively looking, and they could actually get a job prior to their paycheck ending. So um, that effect, it's delayed. It's delayed quite a few months before we'll see them trickling in to the overall unemployment numbers. Again, we're still at a really, even with all the announcements, we're still at a decent um, labor market with zero point 0.9 jobs per every unemployed worker. Now, the 20-year average is 0.71. So we're still quite a bit above the 20-year average. It's just that people are looking at the peak in 2022 of 2 jobs for every unemployed worker, down to zero point 0.9, and they're saying it's weak. Well, it's weakening. It's weaker than it has been, but it's not a weak job market. Um, in fact, I think there's a number of jobs out there now. Certain industries are getting hit. Certain job functions for sure are getting hit quite a bit. And so again, if Amazon and UPS and all these companies that have announced are going to lay people off there because they think they can get more efficient, great. And if they're relying on technology, fantastic. Um, that's oftentimes how creative destruction happens, right? For those people, it's a scary time, but they'll probably, for the most part, land on their feet. If not, they'll get retrained and find other skills. So
Well, one thing I wanted to when I heard this, and I heard someone their commentary on it was that blaming AI or using AI as a reason for things are going to be more efficient. Um, it's a little like in a lot of cases, it's a red herring because it can't do the software development job. So a software developer getting laid off, like it can't do that yet. It in practice it doesn't work that well, that it can completely replace those workers yet. So there's some corporate painting of like, okay, here's, to make it look a little better maybe, or look like, hey, we're forecasting for the future. But I want to remind people, because this has come up a few times, that during the COVID years, 2020, 2021, there was a lot of money flowing into the economy, right? And businesses got really, really big PPP loans for retaining employees. And then in the years after that, they got an employee retention credit for retaining those employees. And so over the last, 5 to 6 years, there was money pumped into the system to support employees. And now those things aren't there anymore. Right. And so a lot of employers, I think, are still, we've talked about this before on the
yeah,
podcast, that, that employers are now letting go of people that they had retained. But again, a piece of that was to get that ERC, the employee retention credit, they had to retain those employees. Well, we're now coming beyond that time frame. So we're probably going to keep seeing that.
yeah, and that's 100% what's happening. I mean, the fact that they're putting the words artificial intelligence in there is more of a PR. Um, it's more of a PR communication than anything else. Really, what it comes down to is what you're talking about, which is the labor hoarding that happened. It was very, very difficult. Like I said, in 22, where you had two jobs for every unemployed worker, it was very difficult to find talent in your area that you needed. So a lot of the large tech companies particularly had this happen where they hired so many people because if you think about it, uh, in 2020, we had to all go mobile very, very quickly. Well, we needed tools and solutions to help businesses work remotely. And so a lot of big tech companies had to do a lot of investment, both in terms of personnel and other things. Well, now the personnel, we're at the point now in 2025, 26, where companies kind of know, okay, we don't necessarily need this many employees. Now, also in terms of like Google's announcement, how many employees do you think Google has?
Oh gosh. Um, I'm going to guess like 300,000. I have no idea. It's a pure guess.
It's a pure guess.
Pure guess.
Let me look it up because I'm curious. Um, I do believe you're probably
The clicky clacks of Brad's computer.
yeah, sorry. Yeah, so they have about 183, 184,000.
Okay.
Okay.
So I was over,
So
but still almost 200,000.
yeah, so 200,000. So 16,000 people. First of all, that is a lot. Okay. It is a lot.
10%, 8%.
Yeah, 8%. So it's about 8% of their workforce. Now, bearing in mind, part of that is they've become more efficient using the technology that they've developed, right? But also they've labor hoarded. So these are larger than normal type layoff announcements because of that labor hoarding. So it's it's something that is unfortunate for the families affected, because it really is it's a scary time for a family to have their jobs um, disappear. Um, but there are also a whole ecosystem of people of companies out there that are vying for new talent because they're growing. You know, any robotics, mobility solutions, artificial intelligence, both hardware and software. Um, I mean, for heaven's sakes, building data centers, building utility plants. I have a friend who's a commercial electrician, and he is writing his own contracts because their electricians are in such short supply that all these data centers need electricians,
Mm-hmm.
and he is traveling around and doing these big projects. So it's something that there are a lot of different jobs available. It's just in your area, you may have to make some changes to your life to take a new job in either a new location, new company, or the like. But hopefully, all those people will get repositioned. I know Google themselves have said they are looking to rehire some of these people in other divisions within Alphabet.
Mm. Okay, so we will keep following that. We'll keep talking about it. But yeah, always good to tap into the both the longer term history, but also the recent history of why these things might be happening. Just so we understand a little better. So along with that, so that's a perfect segue then into our next part of, talking about the nomination for the new Fed chairman that just came out yesterday. Um, his name is Kevin
Warsh,
Warsh.
yep, Evan
Sorry,
Warsh.
Kevin Warsh. Um, we'll talk about that a little bit. He just received that nomination yesterday, and we've already got some different news about him. So let's talk about it. What do we know about Mr. Warsh?
Okay, so Kevin Warsh, 55 years old, he grew up in upstate New York, educated at Stanford in economics and public policy, and received a law degree in from Harvard University. Um, was an a mergers and acquisition investment banker for Morgan Stanley for 7 years. Um, Married into the Estee Lauder family, um, and at that time transitioned from private investment banking into public service, meaning he uh, served on the Fed for a number of years. So he has quite a bit of experience. In fact, he worked with Ben Bernanke during the Great Recession, trying to help offset the damage from what was going on from the Great Recession and the subprime mortgage crisis. So he got a lot of experience there. He's been traditionally known as an inflation hawk, meaning he's going to try to fight inflation much harder than someone else. That he views inflation as a very, very uh, uh, important risk for the Fed to consider. He is someone who takes very, very seriously that the Fed should only pursue the two mandates of full employment and price stability. He doesn't want to go beyond that. He thinks any other purpose for the Fed should be in the federal government, other agencies making rules and laws in those areas, or with Congress. But he thinks that the Fed should only be pursuing those two statutory goals, which is great. But as an inflation hawk, he really has been historically known to um, to criticize the Fed for kind of easy money policy. He agreed with um, quantitative easing as a tool initially, but he had serious reservations about it because of the potential to create inflation and to create financial instability. None of those transpired. But he was so strident in his reservations that he actually, before they did the second round of quantitative easing, resigned to President Obama, resigned from the Fed because he thought they were going down the wrong path. Now he began serving in an administration with George Bush, and he has cultivated and maintained close ties with President Trump, even during his first term and now his second term. He was actually considered for the Secretary of Treasury along with Scott Bessent. Obviously, Scott Bessent got that job, and now he's the new nomination. For the past 15 years, though, he has been working at the Duquesne um, Wealth Family Office, which is Stanley Druckenmiller's. For those of you who don't know that name, Stanley Druckenmiller is one of the most successful hedge fund managers of all time. He was partners with George Soros, and those two together generated a lot of wealth, both for themselves and their investors. And actually, Scott Bessent is one of their former employees, as is Kevin Warsh. So definitely pretty close ties to the Wall Street crowd, which will probably help him if he gets confirmed, help him understand what's going on in the financial markets on a day-to-day basis from his data gathering. He is a huge proponent, which I think is a great thing. He's a huge proponent of using technology to increase and to improve the Fed's models about how to what's going on in the U.S. economy, and how to implement new policies and so he has been recently talking a lot about how the Fed needs to improve their policies and procedures, improve their methodologies and technologies, and forecasting a little better. Now, there's always a risk to that. Just as a side note, if we start making non-data related decisions, then these discretionary decisions you can be wrong on quite a bit.
Mm-hmm.
Similar with data, if you interpret the data or if incorrectly, or if this current environment is different than it has looked in historically, you can make some incorrect decisions. I mean, one of the examples of this is when the Federal Reserve kept uh, low interest rates, expanded balance sheet for a little too long after the pandemic. That's what caused a lot of this large inflation of 21 and 22, and then they tamped down on it, and obviously inflation has fallen. Now, a question to me in my mind is, because he was historically a inflation hawk, he really worried about it. It's interesting that he is now promoting lower interest rates at a time where uh, interest rates by their preferred measure are still a little above their target range.
Mm-hmm.
So I don't know. I don't know whether that is just because he forecasts the labor market falling apart at a much more quick rate or more quickly than we anticipate, and that's definitely possible. So it's just an interesting idea. He's gonna he's gonna have a difficult time getting um, he's gonna have a difficult time getting confirmed, simply because there are some Republican senators who have said publicly that they're not going to even consider him or consider any nomination by President Trump until President Trump drops the lawsuit against Chairman Jerome Powell, because they view that as nonsensical. So it's something that we need to keep in mind, that this might be a little bit more extended of a version. I know Senator Tom Tillis came out and said, I think Kevin Warsh is a great guy, but until President Trump drops the lawsuit against Jerome Powell, this is a non-starter. We're not even going to consider him. So we'll see how that goes. That might cause some market volatility, but possibly doubt.
Well, with that too, when you mentioned, that he literally resigned over the difference of like, we need to not let inflation run amok. The quantitative easing that was done back in 2009, 2010, 2011 was to put more liquidity into the market, right? Like that's what quantitative easing technically is at very, very lay terms. They're putting more liquidity in, and that increases inflation. That increases the money supply, so inflation goes up. So the fact that he resigned over that and has held that position even into 2020, 2021, held that same position that we don't want high inflation. Contrast that with, Trump just came out and saying that, well, our interest rates are probably way too high. Like, I want to see them 2% or three, what did he say? 2 to 3 to 4 points, he said, which is each a percentage lower. Well, if we did that, we would be almost back to 1 and 0 if we lowered that much. And that so there again, we've got that separation of executive desire, executive branch, and the Fed. And so for me, it feels like I appreciate Senator Tillis coming out and saying, like, we're not even going to consider this nomination while we have an active sham investigation going on into our current Fed chair, because that's muddying that independence, right? That's what that feels like, and they're putting that out there that like we want to keep the Fed independent.
Right. And to be fair, Kevin Warsh has also advocated for an independent Fed. I think he sees the risk, at least from what I've read this morning, is I think he sees um, the labor market weakening far, far more than other people are forecasting. So his concern is shifting to that other part, the second part of the dual mandate, which is full employment. And so that is where I think he has spoken and advocated for an independent Fed from the executive branch. um, we'll see how that all goes, but an independent Fed is a precursor. It's a foundational principle in our economy, and has done a very, very good job over a long period of time. Every institution makes mistakes. Every Fed chairman makes mistakes. The process is learning from them. And, I think history, if you study economic history, you can see that since we've had an independent Fed, we've had far fewer blowups, economically speaking and financial market speaking, than we did prior to that time.
Yeah, super important, which we've talked about, and you can go back and listen to the previous episode that's literally labeled why is it important to have an independent Fed. So uh, last little piece here, let's talk about QCDs, Qualified Charitable Distributions. So it's our little education piece for today. A QCD comes from a traditional IRA or a traditional type account where you have to pay taxes on the distributions that you take. This works especially well when you have to take RMDs. So now the age has gone up over the last decade or so. It used to be 71. You would have to start taking at age 71. You have to start taking required minimum distributions, RMDs. Then it went up to 73, and now it's up to 75. Okay, so let's say you are in this age range, you have to take required minimum distributions, or maybe you have an inherited IRA where you have to take distributions from this IRA. It's required by the IRS. Well, over quite a while ago, the IRS came out with a rule that you can take money from your RMD and give it directly. So it doesn't ever touch your hands, but you give it directly to a 501c3 of your choosing. And that then takes away, you don't have to take that for yourself. You don't have to take that money, and you don't pay taxes on it.
So For those of you listening, a 501c3 is a charity that is organized under that IRS code. So it is qualified to receive charitable donations.
Yes, yeah, it's a charity or a nonprofit, but one that has that 501c3 designation from the IRS, so that you can deduct that. Because let's say you have several $1 million in an IRA, and you have income streams from somewhere else, and you don't necessarily need the money that you have to take out from your IRA. But if you have to take out 100,000 or $150,000 and pay taxes on that money, you're going to pay a good, I don't know what your tax rate is, but if you have other income and you really don't need this, maybe you're in a 20-ish% bracket. So instead of taking that $100,000 out and having to pay $20,000 in taxes, you could, up to that $100,000 limit, you could donate that through the QCD, Qualified Charitable Distribution, and then you don't pay any taxes on that distribution whatsoever. The charity gets 100% of that donation. Your RMD is taken care of, and you don't have that extra taxable income on your balance sheet come tax time next year. So it's a really it's a really, really effective charitable donation tool. And you can do, like, most of the time, we don't usually talk about this in January. It's not usually a January topic. Usually we're talking about this in like November, December. But you have all year. You have all year to think about that. If you do have to take an IRA RMD from any IRA, you have the entire year from January till December 31st to do that. And you can decide, you can take that distribution now. If you want to donate it, you have the time to actually decide, versus getting down to, December 1st or December 15th and being like, okay, I got to like just figure something out and do it. You actually can take time to choose where you want it to go. And not that you wouldn't do that anyway, even in December, but you give yourself the benefit of time. With the QCD, typically whoever you hold your IRA with, whether that's, at Juncture, we use Schwab quite often. We also custody with Fidelity now. But if you're wherever you are, Morgan Stanley, UBS, whatever, they will have the paperwork for you to do this. You can't usually do it just on your own through a portal. You're going to need to call. If you have a financial advisor, they're going to be able to help you. Or if you call the customer service line, they should be able to help you. It's not something you can just decide to do on your own without paperwork. So you do have to contact someone. You have to have someone walk you through it. But if you want to look at strategies like that and be able to talk to, me or Brad, or, help you figure out how to do any of that, we are absolutely here for you. It's something that my clients have done many, many times, because they care about where their money is going, and maybe they want to reduce taxes pretty significantly too. So it's a great, great tool for both of those.
Yes. Actually, our clients have used it quite a bit because it really helps the tax efficiency and how you're paying for them. So,
Mm-hmm. Yeah, and again, right now, the limit is $100,000. So if you have an RMD that's $200,000 or whatever more than that, you still have to take the rest of it as income, but you can do you can do up to $100,000 as qualified charitable distribution, and it's not affected by any other distributions that you do as well, or any other charitable contributions. It's kind of its own separate thing, which is really nice. So that is what we had for today. We are going to wrap it up there. And I actually had a couple of other questions that I'm noodling around too. So I will let you know what those are, Brad. Thinking about the Japanese bond market, actually. maybe
sounds
we,
great.
maybe we can
Definitely
talk
talk
about that
about
next time.
Yeah, let's do it.
There's stuff going on there too. So we know there's a lot going on. If you are hearing any other headlines, if you are having any other questions, please send us those questions. We love to talk to you and actually address what you're concerned about right this minute. So thanks, everyone. See you next time.
Thanks.